Hello and welcome to episode 379 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leakes. Now, Damien, it's been a week, but you're still excited. What happened last weekend?
Well, unless you were living in a cave, you know that the women's England football team won the European Championship. And of course, we recorded this podcast earlier in the week, and I'm still buzzing from that fact. I went to the game, as I mentioned on last week's podcast, and took my daughter, and we had a fantastic time. Celebrations and everything like that were amazing. So like everybody, I am buzzing, but it ties in quite nicely with something that we've not mentioned before on the Money to the Masses podcast. But we actually decided to sponsor 2 local girls football teams back in May. And today we've just got the first image of the new kit. So our logo will be appearing on the shirt, and it's a kind of a light blue Man City colour. The girls got to choose the colour they wanted, and we sponsored it. We have shared that on social media today, so it links in very nicely with the whole euphoria that's around women and girls football at the moment. So we've sponsored 2 separate teams, and we've even been able to pay towards some equipment that can help them track their fitness. And the Premier League players have, where they have the trackers that they wear in their sports tops, they've been able to have some of that as well. So it's really helping those girls team, and something that Justin and I in particular are very passionate about. So it's quite a nice circular story, really. So I'm really happy to be able to share that.
Okay, so let's get on with the podcast this week then. And we've got 3 pieces as usual. So Damien, what have we got coming up in this week's show?
So I'm doing an investment piece this week that's inspired by an 80/20 investor research article that I've written, and it's to do with value. So you can use different measures to try and determine if a stock market or a sector within the stock market represents good value, i.e. is cheap, and therefore could represent an opportunity to enter that market and then make a profit when the rest of the market and other investors catch up with the idea that it's undervalued. So I've crunched the numbers and looked at key stock markets around the world, as well as sectors in America, to determine which are expensive and which offer good value opportunities for investors. The second piece I'm covering is related to a scam, in particular an Apple scam, but there are lessons to be taken from that scam. Thirdly, Harvey is coming onto the show today to do a piece about the little known facts in relation to income protection policy, something that we've spoken about in the office and some bits and pieces that I didn't even know. And actually there is a 4th piece this week, a bonus piece that relates to the interest rate rise that the Bank of England implemented this week, where they moved the base rate from 1.25% to 1.75%, somewhat unexpectedly. And I'm going to tell you what that actually means for you and your mortgage payments, and where the market now thinks interest rates will head over the next 18 months.
Okay, so let's start with the main investing piece then that came off the back of some research you've done for 80/20 investor members, and it's to do with value. So what have we got?
So I wanted to talk about value opportunities in investment markets, and in particular equity markets. Now, anybody who follows the market updates that I do or this show may have heard me talk about how value stocks have outperformed growth stocks during 2022. And obviously valuation is quite a subjective thing, because a stock, for example, is deemed to have value if you perceive it to be detached from its fundamentals in some way. So you think a company's share price is lower than it should be based on perhaps some knowledge that you have that other people don't, or based upon a view that you have about where the future is going, maybe economically or in a given part of the economy. Now, the trouble with value investing, which is where you buy things that you think are cheap, and therefore you hope the market will realize the true value of the stock that you may have bought, and therefore the price rallies significantly, and you ride that on the way up and you make a handsome profit because you've basically seen an opportunity before everybody else does. The problem with that is sometimes things are cheap for a reason and they can get cheaper. And of course, someone's perception of value may differ to somebody else's. Now, one of the ways that investors may perceive value is through that price to earnings ratio that, again, I've spoken about in the past. So price to earnings, where they'll look at the share price of a stock versus earnings, and that will give you a ratio. So you divide one by the other, and you can plot that over time, and you can see what the historical average is, and then you can see where the current ratio is and judge whether that is expensive based upon history or cheap. In general terms, what you're thinking is, are you paying too much for the earnings potential of this particular company? But the one issue with that is the price to earnings is often forward looking. So you're looking at the earnings going forward, maybe over the next 12 months. And of course, in an environment like we are in now, where we are really uncertain about the potential earnings of companies because we may be heading into a recession, we have got a cost of living crisis going on, and we've already seen some companies raise concerns in their forward guidance when they've issued their quarterly earnings update in recent weeks and months, saying that they may struggle to make as much profit or revenue than they had projected in the past because of these headwinds. Not all companies, but obviously there are a significant number, and they're called earnings downgrades. And we've seen that over the course of 2022. But one way of establishing value is something called the cyclically adjusted Shiller PE ratio, or CAPE for short. So it's CAPE. Now, it's a well-known ratio that was created by a Nobel Prize winning economist, Robert Shiller. And what it does is it looks at the price of a share compared to its earnings ability over the last 10 years. So it's a backward looking measure. And so it smooths out the volatility you get in earnings by looking at over that 10-year period. So then obviously you get a CAPE measure for that particular stock that is cyclically adjusted PE, and you can compare that to the historical average. Now, why this gained popularity is because Robert Shiller effectively predicted the dot-com bubble bursting in 2000. And since then, you'll hear pieces about what Shiller thinks about where stock markets are going. And generally speaking, in the US in particular, they've been really expensive for a number of years. People have been calling a crash due to this CAPE measure, but it hasn't actually materialized. Now, what I want to do today is, you don't have to get bogged down on how CAPE works. You just need to know it's been a reliable measure of value. Again, it's not foolproof like any measure of value in stocks and investing, but it's consistent and has shown an element of reliability more so than some others. And because it's backward looking, I think that gives it some validity in the current environment. But what I want to do is compare where we are now, given that we've had this slump in stock markets globally in 2022 compared to where we were at the start of the year, and where the opportunities lie. Because obviously when markets fall, then there are some value opportunities that start to appear that perhaps weren't there before. And we've seen some significant corrections, not just in terms of geographical locations and stock markets, but also in the underlying sectors themselves, so areas of the stock market. So this piece was born out of a piece of research that I'm updating for 80/20 investor members. So I'm going to pick out some nuggets. I'm not going to give it all away, but I'm going to pick out some nuggets and some interesting places that people might want to look at. Now, if you think about markets back at the beginning of 2020, if you look at across Australia, Brazil, Canada, China, France, Germany, India, Indonesia, Italy, Japan, Malaysia, Mexico, Poland, South Africa, South Korea, Spain, Sweden, Switzerland, Taiwan, Thailand, Turkey, US and UK, all areas that I look at in this analysis, then there were a number of very expensive areas, and they were focused particularly based on CAPE and a historical median. Then areas that were expensive were mostly developed world equities. So we're talking about, in particular, France, Germany, Spain, Switzerland, and obviously the US, because the US obviously contains some of those big technology stocks which have huge valuations based on future earnings. So to give you an example of the US, the median, the long-term average, is 16.4 for CAPE. Now, back in October 2021, that measure was at 38.7. So it's not even close. It's more than double. That is eye-wateringly expensive. Now, we've had it being expensive in the US for a number of years now. When I've done this analysis about 4 years ago, it was expensive then, but it got even more expensive. So the share prices continue to go up. Part of that is because of distortions, because of what central banks do, but some of that is just down to investor exuberance. So what's happened now we've had this sell-off? Well, technology stocks were absolutely battered. So part of that has driven down the CAPE for US equities to 28.7. Now, that is still a long way above 16.4, but it's a bit more attractive based on history. Now, if you've gone back to the start of the year, interestingly, UK equities were good value. They actually were just under their long-term average of 14.3. They were 13.8 is the CAPE in October 2021. So they represented good value. Now they're at 13.4. So they still are an attractive value proposition. And actually, they held up better than most developed world equity markets in 2022. So if you'd bought them at the start of the year, then you would have been quite pleased. Now, what is interesting is looking how things have changed. If we look at Europe, as a group, their long-term median CAPE was 16.7 and it was 19.9 in October 2021. So they were expensive. Now it's 16.7. So it's bang on its long-term average. So it's neither expensive and it's neither cheap. It is par. And obviously, we've known what's happened in European equities, largely driven by not only recession fears, but mostly because of the Ukrainian war. So Europe is now, as a whole, representing a value opportunity. So somebody who was trying to be a contrarian might start thinking they want to look at European equities, but of course things can get cheaper. And if we look at individual countries, Germany was expensive. Its long-term median was 17.6. That's now plummeted to 12.9. So that represents cheap. Similarly, if you look at Spain, that's dropped to 13.3 versus its 14.1 long-term average, and it was expensive back in October 2021. So there are opportunities on individual country basis in Europe. I won't go into the full details, but as a whole, nowhere has got more expensive. Everything has become more attractive from a valuation perspective, become cheaper since October 2021, but by differing amounts. Now, I'll give you a couple of areas that remain expensive. Switzerland and Taiwan are good examples, and so is India, actually. Now, if I had to pick two that have shown the biggest fall from expensive to being attractive in terms of valuations, Germany is probably one of them, and Brazil is another. And part of Brazil's is because it's an emerging market economy, but also because of the commodity exposure that investing in Brazil gives you, because obviously they export a lot of commodities from their economy. So Brazil has gone from being quite expensive over a long-term valuation perspective at 17.7 versus median of 14.6. Now it's dropped all the way to 11.6. So Brazil was an opportunity, but if we get a recession and commodities continue to slump, then maybe Brazil wouldn't be the place you'd want to invest. But from a valuation perspective, it looks attractive. Emerging markets are now looking favourable from a valuation perspective, while developed equities are still expensive. So even we know we've had the sell-off, what we've seen is valuations for most in emerging markets and opportunities in terms of valuation as a group for developed world equities are still expensive, but that's largely because of the US. Now, what I want, if we go back to October 2021, what I want to do is talk about US equities for a moment, because if we drill down to sector, we can use the sector valuations as a quasi benchmark for them globally. And if we go back to October 2021, the overpriced sectors were things like cyclicals and US technology stocks. And in particular, if you break it down, it was the technology sector on the S&P 500, the communications services sector, and the consumer cyclical sector. And that kind of makes sense, because when the economy was recovering from the pandemic and we had all that easy monetary policy that helped boost the economic rebound, then consumer cyclicals will tend to do well in that environment because they are sensitive to economic growth. And so investors were buying those en masse. They pushed up the stock prices, which in turn pushes up their valuation. Technology stocks, on the other hand, have been expensive for a number of years. And during the pandemic, they also attracted a lot of money as people used them as a defensive play. So at the market highs in October 2021, we had those sectors that were very expensive. By contrast, the opportunities lied in energy. So energy stocks were relatively fair value. And that's because if you think about the pandemic, we were having the recovery, but inflation hadn't taken hold quite at that point. And commodity prices hadn't taken off. We were still at the point where commodity prices hadn't risen significantly for a number of years. And the value was attractive enough to tempt Warren Buffett even. But if we fast forward to August 2022, where we are now, then the situation looks very different. In fact, energy now is very expensive, and that's because energy stocks have rallied aggressively, as you all know, and it was the best performing sector in the first half of the year in the S&P 500. In fact, the current CAPE is almost twice the 10-year average. By contrast, consumer cyclicals now are just below their 10-year average. So they're starting to represent good value, almost bordering on cheap. And so that may be an attractive entry point for those who've been waiting for value. They didn't want to overpay for technology stocks in the past because they thought they were expensive due a correction. Well, now we could be entering that point. And obviously the communication services sector includes things like Alphabet, which is Google's parent company, and Meta, and technology sector, which includes things like Apple, is much closer to its 10-year average as well. But overall, only the energy sector is more expensive now following the market sell-off that we've experienced than the valuations back in October 2021. And given that the sell-off was centered around technology stocks, perhaps it's unsurprising that the valuations have become much more attractive in those sectors. But overall, if we look at the market, yes, US equities are still expensive on a valuation perspective, but now within the S&P 500, out of the 11 sectors, there are 5 that are classed as cheap based on their 10-year average for CAPE. And as I say, that includes the communications services, but it also includes financial services as well as real estate. But I won't give any more away. If you want to hear any more, obviously you've got to look at the 80/20 investor research. So the message from this part of the podcast is that the market has changed, and things that we thought were expensive in the past now are no longer so. There now are opportunities to buy into sectors that were historically expensive, that if you believe in CAPE were due a correction, and we've certainly seen that in technology stocks. You could pick any number of technology stocks in the US, and October was pretty much the high for many of those stocks, and they can be down around about 60% since then. So their valuations are attractive. Now, just remember, just because something is attractive from a valuation perspective and it's cheap doesn't mean it will necessarily go up in value. But we are in a different world than we were before, and that is interesting. So as an investor, you might have to change the way you view things. Some of the old beliefs about what was expensive and what was cheap have shifted and almost turned on their head since October 2021.
Okay, so let's move on to the next piece of the podcast. And we're going to be welcoming Harvey back to the show, who's here to talk about income protection. Now, this piece was actually inspired by a piece on the radio that Harvey was listening to and was frustrated to hear that the advice that was being given out wasn't correct. And it made Harvey realise, hang on, I need to set the record straight on this, because actually these are interesting facts that people should know about income protection. And we thought it would be a great piece for the pod. So Harvey, welcome back to the show. How are you doing?
Very well, thank you, Andy, and thanks for having me back.
So what happened then? You were listening to the radio and there was a piece that came up about sick pay benefits, and someone was asking a specific sort of nuanced question.
Absolutely. I mean, most people wouldn't have thought about this, but it's interesting. And I think that for more people that are thinking about buying income protection, it's a reason why you should consider it. And actually, this lady who was asking a question of a legal expert on the radio was asking about something that's quite nuanced within the benefits within income protection policies. So her partner was claiming against an income protection policy. He was a builder and couldn't work as a builder anymore. So he was receiving a benefit from the insurance company to supplement the loss of income that he suffered as a result of that. Now, he had the opportunity to return to some work, and it would have been lesser paid work. And she was trying to work out whether the benefit would continue, whether it would stop if he took up this other stream of income. And it got me thinking about how little people really understand about income protection policies, because the legal expert couldn't really help with that situation. And there is more to be understood there.
Okay, so we're going to cover 3 specific areas of income protection where they're kind of little known facts, and we'll go through each one individually. So proportionate benefit is the first area we're going to tackle. Now, this was specific to what the lady was asking on that particular show. So can you explain what proportionate benefit is, Harvey, and actually how it could help someone who is claiming on income protection?
So proportionate benefit allows people to phase back to work. And what I mean by that is that people who are unable to work and start claiming against their income protection policy, start receiving a benefit that is paying them enough to hopefully meet their bills and their financial commitments when their sick pay stops. They then may find themselves in a position when they start to recover from the illness or the injury that they suffered, that they can return to work, but perhaps not for the same amount of time or not for the same pay, that they could phase back to work. And at that point, it can be a difficult decision to give up the benefit that you're receiving from your income protection policy to take less pay from your employer as you phase back to work. And what the income protection insurance companies do is they support you back to work through this thing called proportionate benefit. Because what proportionate benefit does is it tops up what your employer pays you up to the amount that you would have been receiving for your benefit or more, so that you're incentivized financially to go back to work. And as much as we might like to think that people would quite happily sit at home and receive a benefit from their income protection policies, largely that's not the case. Most people want to get back to work. It's healthier for them. They can get on with their lives. They can get on with building their careers and progressing their careers as they'd planned to do so before they became unfit to work.
Because let's not forget that these people who are claiming on income protection would have been in either part-time or full-time work, would have been quite happy in that job potentially, but something unexpected has actually curtailed that. So they'll have colleagues that they want to get back. And so, the social aspect, the mental health side of things is every reason why someone might want to return to work, not just the money as well. So is there any limitations to this? Is there anything that people need to be aware of?
When you look at it, most income protection providers do include proportionate benefit within the policy. Just make sure that the terms and conditions say that it's there. When you look at the terms and conditions, you may find there are a small number of insurers that will limit the duration of that kind of payment. So if your phased return to work is a matter of weeks, you might not be bothered by this, but none of us can predict the future. And some companies limit the duration for which you can receive a proportionate benefit that tops up a phased return to work, whereas others don't. And obviously the ones that don't limit it are going to be better for you. So as nuanced as that is, I'd always say look at the terms and conditions and just check that you're getting the best for your money.
Okay, so let's move on to another little known benefit of having income protection. So we talked there about proportionate benefit. There's also something called rehabilitation benefit. What's that?
So they sound similar. And yes, I know it gets confusing. And this is where we try and sort of take down the jargon and help people to understand these things. But rehabilitation benefit pays for types of therapies that might help people to get back to work. And sometimes they can be paid out even whilst you're working. So if you need things like physiotherapy, occupational therapy, some insurers even cover things like Reiki in that you could actually have your income protection policy pay for certain therapies that could keep you in work or get you back to work, depending on what circumstances you're in. But it's a little nuanced benefit that sits within your income protection policy that you may not know about. And, insurance companies don't sing it from the rooftops, because ultimately it's up to you to look within the terms and conditions of your policy and work out whether you want to claim against something like that. But again, if you're about to buy an income protection policy, do have a look and check that your insurance company includes rehabilitation benefit, because unlike proportionate benefit, not all insurers will offer it, and the levels of cover do vary.
That's really interesting, because I always thought things like physiotherapy, occupational therapy were always just benefits that were going to sit under something like a private medical insurance. Something like income protection that pays out an actual cash benefit, if you like, to support your income. I didn't think that would be available within an income protection policy. So it's really interesting. Are there any limitations? You've talked about nuances there. Do certain policies, say, have a cash limit or something like that?
Absolutely. Some of them do have cash limits. Some prefer to pay you just a cash sum of money if you're claiming. Others will let you source the therapy that you need and will pay the invoices that are raised against it. So there are a number of different ways in which you can realise the benefit. Some of them pay the benefit out as a multiple of your benefit amount. So whatever your monthly benefit is on the income protection policy, it could be a multiple of that. So I've seen some insurance companies pay 3 times your monthly benefit for it. But also you've got to look out, because some insurance companies have this benefit included on a discretionary basis. And whatever somebody says that something's available on a discretionary basis and you can get it on a non-discretionary basis, always opt for the non-discretionary basis. And you may find that there's no cost difference in those two policies. But if I ever found myself in a situation where I wanted to claim against a benefit, I'd prefer that it was non-discretionary. And with the rehabilitation benefit, Andy, some insurance companies will only pay for rehabilitation therapies if you're claiming against the policies, whilst other insurance companies will pay for these kinds of therapies regardless of whether you're claiming and you're off work. And that's not, because insurance companies want to give you lots of money, but because if they can pay for therapies that will mean you stay well or keep you from becoming so ill that you become too ill to work, it's to their benefit as much as it is to yours, because you wouldn't be off work and you wouldn't be claiming and they wouldn't be paying out on your income protection policy. So as much as I'd love to say that insurance companies do this from the goodness of their hearts, they do it because it keeps their claims down as well.
Great. So if you've got an income protection policy or you're thinking about getting an income protection policy, we've covered two areas there, proportionate benefit and rehabilitation benefit. So make sure you keep an eye out for those. And the final one we're going to cover is something called carer benefit. What is that, Harvey?
So carer benefit can sound a little bit like the state benefit, which is called carer allowance, but carer benefit is another little known benefit that sits within an income protection policy. Let's not lose sight of the fact that obviously income protection policies are largely there so that you're paid an income if you become unable to work. But one of the questions that sometimes comes up from people who are looking at income protection policies to protect them as the earning individual within their households is, what if somebody within my household became ill and I had to stop working in order to care for that individual? So my income would stop, but I'm not necessarily unwell or ill. So I'm looking for something that can financially support me to make that decision to stay at home and care for somebody who is close to me. And carer benefit does exactly that. It pays you an amount of money, which can vary depending on which insurance company you put your product with. So again, you do have to look at the terms and conditions, and it's worth getting a bit of help with these things if you really want to nail down the best kinds of benefits in the market. But what it would do is pay you a benefit so that you could stay at home and look after your wife, your husband, your partner, your child, your parent, and some policies even allow you to care for anyone. They don't have to be related to you. So it's really worth looking at the small print here and checking that your policy is doing the best it can. So if you're going to buy an income protection policy, then do have a look and check whether there's a carer benefit included. It isn't always included, and it's worth looking at the detail of the limitations that apply to that benefit.
And so what's the qualifying criteria in order to claim on this? Does somebody have to meet a certain definition in terms of their incapacity in order for this to pay out?
They do. With all insurances, you're going to have parameters within which you can make a claim. So the individual that you're caring for will usually have to be unfit to the point where they're unable to do a certain number of tasks within a list of tasks. So most insurance companies set out a list of tasks, and that can be things like climbing a set of stairs, walking a certain distance, dressing yourself, feeding yourself, caring for yourself, things like that. And there'll be a number of these listed within the policy. And usually the individual that you're caring for doesn't have to meet all of the criteria, but there'll be a minimum number of those that they shouldn't be able to do in order for the insurance company to qualify your claim.
And is there a number of hours a week that you need to be giving care for, again, to meet any sort of qualifying criteria in general? I know it will change from insurer to insurer potentially.
There is, generally it's 35 hours. Again, look at the terms and conditions of your policy, but usually you'd have to be in a position where you're providing 35 hours of care for the individual that's concerned. It's a little bit like the carer allowance that's available through the state as well. But remember, this is based on your income protection policy, and the benefits might be in excess of what you would be able to claim through the state, making it much more attractive. And again, it's a little known benefit that sits within your own income protection policy, which for the vast majority of people that buy income protection, it's there to support you if you're unable to work and replaces your income. But it does all these other things whilst it does the main benefit as well.
So we've covered three really interesting and important benefits there: proportionate benefit, rehabilitation benefit, carer benefit. If you've got an income protection policy already, keep those in mind. If you're shopping around for income protection, again, keep those in mind when you're doing your comparisons. And if you do need help when you're doing income protection quotes, do make sure that you check out the Money to the Masses website. We'll put a link in our show notes and also on the article post that we put on the website for the podcast every week, with details on how to find more about income protection, what it is, what it does, the types of insurance, roughly how much it costs, but also the best place to buy it as well. Okay, so Damien, bringing you back in then. Apple scams. There's another scam going around. What have you got on this?
So this week I wanted to talk briefly about a new text message scam, and this one impacts Apple Pay. Now, you're always getting various different text message scams that you need to be wary of. So after I've talked about this particular scam, I will talk about some tips to avoid falling foul of them. But the Apple Pay text scam message has been doing the rounds and has become quite prevalent. What happens is that you receive a text message supposedly from Apple, which says something like, Apple Pay has been suspended on your device. Please visit, and then there's a URL. And that web address has words like secure written in it. Now, what happens if you were to click on that link? It's nothing to do with Apple. You'll be taken to a website where you'll be asked for personal information. Now, if you get a text message, anything like that, then you just delete it, because it is a scam. It's nothing to do with Apple, and it's a way of scammers phishing details. Now, just to give you an idea what could happen, if you clicked on that link and you went to the website and entered in some of your information, depending on what they asked you, they could then use your identity to take out credit, or they could access bank accounts, depending on what information you gave them. So even assuming that you didn't give them lots of information, because maybe the form was quite limited to make it seem somewhat legitimate. So let's say they only asked for the first few details of the card number associated with your Apple Wallet. Even by doing that, there have been instances where the scammers then subsequently contact you out of the blue. Maybe it will be a phone call where they will then ask for more information, but they'll probably pose as your bank, because even with just a limited number of digits, say the first 4 digits of your bank card, they can tell what type of card it is, Visa or MasterCard, and which bank issued it. So they could then contact you pretending to be from your bank. And don't forget, the other technique that fraudsters use is spoofing, where they can in fact trick your phone into showing that they are calling from your bank. And it's easy to fall foul of that, and you think that it's your bank, and then you release even more information to you when they do a fake identity check or security check over the phone, and then they can then access your savings, etc. And then you could become yet another one of their victims. So make sure, if you receive a text message of any kind, with this particular one, I've told you the wording, but that can change. But if you get any text message, first of all, never click on a link, because most companies won't require you to necessarily click on the link, but also look at the information. The link will look pretty bogus because it'll probably have an odd URL. If you look at it, most of these text messages look pretty amateurish. So they have typos, they have misspellings, they have odd capitalization. The number they come from often doesn't even look like a number for a legitimate company. It looks like it's coming from a mobile phone. These are all flags. If you then get the message and you just Google it, often you will find other articles online that talk about the text message you've got. So you will not be, or very unlikely to be, the first person ever to receive that particular message. Now, if you do receive them, the first thing to do is block the number, but you can do that by tapping on the icon on your phone, but block the number. You won't receive any more text messages. You can report fraudulent or suspicious text messages by forwarding them to a number 7726. That's a free scam text reporting service. And if it's related to Apple, then you can report them to Apple Pay phishing scams at reportphishing@apple.com, and phishing spelt with a PH. Now, another popular one that we've mentioned before, but is worth mentioning again, are the delivery services. So you might get a text message supposedly from a delivery service where you're maybe expecting a package, and again, they will request that you click on the link, ask for financial details, etc. Just delete them. If you think a message has come from a company, then go and check your emails, because you should have received an email from the company. And again, you can contact the company directly, because of course emails can be dodgy too. Now, just to reiterate that, there are a host of other Apple scams doing the round, such as one where they send a fake invoice email scam that, again, very dubious links and email addresses used in that. But they want you to click on the link and go through and then again provide financial information they can use. And there's another text version that I've seen which says that your Apple account has been locked, and in order to restore access you then need to click on a link. So again, always make sure that you go to the legitimate website, not via a link. Go yourself by typing it into your browser, logging in, and you can check whether you have any messages from the likes of Amazon, etc. So do be careful and do treat any message that you receive suspiciously until you can confirm otherwise.
Okay, so let's finish off this week's podcast with a little piece about interest rates. Damien, we all heard the news this week. What have we got?
So the Bank of England increased the base rate in August 2022 by 0.5% to 1.75%. And that's the biggest jump in 27 years. And that was the sixth consecutive increase by the Bank of England, which is unprecedented. Now, what does that mean for mortgage borrowers? Well, if you're on a fixed rate mortgage, then your mortgage repayments each month will stay exactly the same. But if you're on a variable rate mortgage or a tracker mortgage, then you're likely to see your mortgage rate go up by a similar amount, i.e. 0.5%. So what does that mean in terms of your repayments in pounds and pence? Well, for every £100,000 that you've borrowed as a mortgage, then you're likely to see your mortgage repayment go up by £26 a month. So if you do the numbers, if you've got a £200,000 mortgage outstanding, then your mortgage repayments a month are likely to go up by £52. And we've assumed you've got a repayment mortgage and it's over 25 years. And that's all because of this 0.5% increase to the Bank of England base rate. It does also mean that if you've been on a fixed rate mortgage since before December 2021, which is when the Bank of England first started raising interest rates, then you're likely to see your mortgage go up by £86 a month for every £100,000 of mortgage that you've borrowed when you get to remortgaging. So it's a sizable chunk and you're going to have to plan for that. So what is going to happen to the Bank of England base rate going forward? Is it going to just keep going up? Well, much depends on the economy and in particular inflation. Now, if inflation proves sticky, that could be a problem and the Bank of England may be forced to keep hiking rates. In fact, in their latest prediction, they've said that we can expect to see inflation in the UK go above 13% in the coming months towards the end of 2022. Now, previously, the market had predicted that the Bank of England base rate would rise by 0.25% this August and 0.25% in its September meeting. Well, we now know what happened in the August meeting. It had gone up by 0.5%. So it just shows you how any predictions are wrong, and they do change all the time. But at the moment, what we're seeing is the market is pricing in that the base rate could rise above 2% before the end of 2022 and above 2.6% by the end of 2023. Now, if you want to get the latest information about what's happening with the predictions for the Bank of England base rate and by association mortgage rates, then make sure you check out our article on the Money to the Masses website, which we link to in the show notes, which talks about the predictions for the Bank of England base rate and whether they're likely to go up or down. So if you're coming to the end of a mortgage deal, particularly a fixed rate deal, or maybe you are thinking of getting off your tracker mortgage rate or your standard variable rate, then you may need to act fast because the best mortgage deals are disappearing all the time, especially if the market starts to believe that the base rate is going to keep increasing, which they are currently thinking. But there is good news because you can fix your mortgage rate even if you're coming towards the end of your mortgage deal now. And it means that you can lock in a better rate than you may be able to get in a couple of months' time. And we explain how to do that in the article that I've already mentioned. But ultimately, if you are worried about your mortgage rate rising, then you need to speak to a mortgage advisor who can search the market for you and find the best deal based on your personal circumstances, because the deal that you are able to secure will depend on factors including your income as well as your credit report. And then we will provide links in the show notes to how you can find a mortgage advisor if you don't already have one.
And so that's it for this week's podcast. Don't forget, as always, you can get in touch with Damien. It's Damien at moneytothemasses.com. Again, we've got lots and lots of stuff going out on Instagram. If you haven't followed us on Instagram, make sure that you do. You can check out Money to the Masses as a sponsor for the girls' football teams, along with all the other content that we put out on there. And don't forget, we've got the Money to the Masses community group over on Facebook. It's facebook.com/groups/Money to the Masses. And you can put questions to the group, and there's lots of like-minded people in there. And don't forget, there's the Money to the Masses YouTube channel where we're putting up 3 videos a week. And there's a mixture of content on there. There's product reviews. And actually, we answer lots of questions that you guys put forward from the Money to the Masses community group. So do make sure that you subscribe to that. So Damien, that's it. We're done for this week, aren't we?
Yep, we're done for this week. So until next time.
Until next time.